Hello and welcome to another edition of Nucleus Investment Insights. This one we're having a look at will the RBA panic and hike interest rates? Have Dave Llewellyn-Smith all queued up ready to come in. I'm just going to start by just running quickly through some of the disclaimers. So I just want to note that everything you hear today is not personal information, not personal advice. It's all general in nature. If you do want personal advice, then give us a call, drop us an email, and we can hook you up with somebody who can do that for you. But without any further ado, I will bring David in. Welcome, David.
Thanks, Damo, and hello to everybody who's tuned in today. So we're going to have a look at a subject that always drives robust discussion at dinner parties. What's going to happen to interest rates next? So we're going to run you through, so roughly, what the state of play is at the moment, where Australia's inflation problems lie, what the federal government is doing about it, what are the sort of tailwinds, So where the inflation is coming from, the tailwind to inflation, also the headwinds to inflation, which have been driving it down, how strong they are, and will they win? And then we'll draw a conclusion about what we think the RBA will do, and then just wrap up with investment implications. So jumping straight in, where are we at? We've got a very handy chart here from the CBA, who are pretty much the best macro team in the country these days. Used to be, in our view, Westpac, but after Bill Evans retired, some of the quality of their material fell away, and so we look more to CBA for if you like, orthodox data. And so I've provided a chart here just on where inflation has been tracking in the monthly and quarterly indices. And as you can see, we've obviously been through the huge COVID spike, and we've come down a long way from there already. And in the last 4 months, 4 monthly CPI indicators, we've been a little bit stuck around 3.5% inflation, which is obviously 0.5 above the RBA range, and so still has them a little uncomfortable, even though they've brought it down from closer to 9. Now on this chart as well, you'll see what the RBA forecast is that they put out in their statement of monetary policy, and as you can see, even after the last what was above expected inflation in the last few monthly indicators, plus the last quarterly CPI that we had out a week or so ago that got everybody upset, we're still very much tracking on the RBA forecast line for disinflation. But, more or less owing to the experience overseas, the RBA was pretty sensible about how long it would take to squash the last mile, if you like, of inflation, which is always the hardest to squeeze out of the system. And so they gave themselves almost a 2-year period of just gently falling disinflation out to near the end of 2025 before they're, well and truly back into their forecast range. And obviously this plays into how they think about where the neutral interest rate is, what's tight, what's loose, and where it should be to hit this forecast. And at the moment, despite one bad quarter, we're well and truly on track with their outlook. So just as a neutral starting point, I think the RBA will look at this and say, well, we're still roughly on track where we thought we'd be. What you can also notice here is that we got well ahead of the RBA's forecast in the December quarter. We had a very soft quarter of inflation. So, at that point, there were some, including me, who got a little overexcited and thought that the rate cuts might even come in the first half of this year. And I think the lesson that I learned from that, and I think some other very hawkish forecasters out there at the moment should should probably heed is don't react to one report, basically, because these things are all about trend. And so the Doves were all winners and champions in December, and now the Hawks are all going absolutely bananas here in April, when in fact, you just shouldn't overreact. You don't panic to one report. So crucially, at this stage, Australian inflation is essentially on the RBA's track, and that's based on current interest rate settings. So from that, you can conclude that they won't panic from just one report, but we'll go through some more things and see if that presumption holds. So if we flip over to our next page, Australian inflation is different to a lot of the other developed markets. Let's take the US as the best example. US inflation, like Australia, US inflation has quite strong services inflation. In fact, it has goods deflation, and even things like oil and transport are not adding a lot. It's nearly all services inflation in the US, and traditionally services inflation is very, very closely yoked to wages growth. So they tend to track each other very carefully. Now, in the case of the United States, they have a structural labour deficit. They lost a lot of workers during COVID, about 5 million workers. Lots of retirements, I guess some deaths, and people that just decided they weren't going to leave the house anymore. And so, their wage growth got much higher than Australia's during the COVID period. And it was the wages that were playing a very important role in driving up their services inflation, and is now sustaining it because their wage growth is still quite strong. At the moment, it's just above 4%, but their last quarterly number had pushed it annualized back towards 5%. And so they have a very, very, very strong labour market.
Yeah, and the other thing is, so their housing's turning negative now,
Yes.
or very low, and so if you look at this, the services includes housing, and so if you strip that out and go and look at Australia, so Australia's has got this high housing thing it's carrying, and then the rest of the services isn't as high, and the US is the other way around. Is that?
That's right. And so in Australia's case, we don't have high wage inflation. Like, we got to just over 4%, and a lot of that was muscled up by regulation. It wasn't even sort of transpiring in the private sector by itself. It had to be forced up by Fair Work, which regulates wages.
Minimum wages.
Sorry, what?
Yeah, the minimum wage.
Minimum wages, right, and awards. And so they put through a big rise, and that gave a bit of a boost to inflation. But the private sector Australian inflation has been falling now for really like 3 quarters or so.
And 4% growth is what you want from that's just a normal economy.
That'd be great if it was sustained there. So Australia doesn't have a wage problem.
And sorry, and just to clarify, that's basically what we're looking at there. Is that's your inflation of sort of 2.5 or whatever plus productivity growth.
Yes, that's right. Which would give you hopefully your living standards are rising through those that wage spread. So that's right. But instead, what Australia has got is a massive abundance of labour, which is, we'll get to this shortly, which is killing off wage growth quite quickly. But one of the reasons for that is that we've gone all in on an incredible surge in population via immigration. Now, that's created some supply side constraints, not in labour, because it's people, obviously, that are coming in. So there's loads of people looking for work, but in infrastructure and essential services to people, for people just to live. And so I've just circled a couple of the areas that have been really sticky over the first quarter in Australia. And you've got housing, which comprises the building of houses and utility bills, etc. It's the largest component in the overall CPI. It's about 20% of the CPI, and it's very sticky because we have a massive housing shortage, and so there's all this demand. But unfortunately, at the same time, building costs have gone up a great deal, and so it's actually not profitable to build a house at the moment. Builders actually lose money building houses. So we have, therefore, the other component of housing here that's really important is rents. We have rents going absolutely through the roof because we've got all these new people, and builders can't build with a supply response to house them. And so rental stock is under immense pressure. And so that's where you're getting that really, really sticky housing inflation, which is a direct result of overcooking immigration, basically. Now you're seeing similar things in, like, for instance, education, which is these days, not much more than a pipeline for immigration. So you have an enormous quantity of people who are coming through via student visas, and so education's just red hot in terms of demand, hitting the same constrained capital stock, and so it's sticky there as well. And you're starting to see it a little bit in health as well, because you've simply got more people visiting the same number of GPs, hospitals, etc. And I've thrown transport in there is just oil, really. But so you've got these particularly sticky areas that are very self-inflicted by the federal government, much more in theory easy to manage because you just cut immigration and you'll take the pressure off, and these prices will start to come off. That's if you have a sensible fiscal manager, right? Whereas in the US, if you have a structural labour shortage, then it's much more difficult in theory to get inflation down because you simply can't find the workers. And so you have to be thinking about higher interest rates or other innovative ways of bringing activity out of the economy, for instance, tightening fiscal, etc. So it's a much trickier problem in the US, and it's a much more stupid problem in Australia. So I'm not saying it's not a problem, it's just a dumber problem because it's self-inflicted. So with that in mind, that's your tailwind to inflation, basically, in Australia. We do have, however, some very strong headwinds that are building that should continue to weigh on those service inflation points, even though they're under all of this demand pressure. And it's basically, it comes down to the same thing. We've got wage growth is dying in Australia for the same reason. And you'll see a couple of charts I've got here, one on the left. Your job applications are absolutely through the roof. They're up around like full bore recession levels, even though it's not registering in the official unemployment rate. But there is mounting evidence that official unemployment rate simply cannot cope with current circumstances. And so it's seriously underscoring the looseness of the labour market. And the primary culprit for that, again, is mass immigration, because if you have 100,000 new workers coming in per month, how do you possibly measure them in your standard set of 8 or 10 labour market groups that you rotate through? And you're simply not going to capture the distribution of the way that the labour market is changing so fast. So this is a problem that's actually been discussed quite broadly overseas. And the FT picked this up a couple of weeks ago and looked at what some other central banks are doing to try and come to terms with this, because we have not as higher immigration as Australia, but reasonably high relative to history in US. That's how it's trying to address its labour shortage in part. Reasonably high in the UK, high enough for it to be starting to trouble how they measure their labour market looseness or tightness. And Canada is the same, where they've actually gone they've actually outdone Australia. They've had like 1.3 million migrants in the last year, and so their statistical bureau is really struggling to figure out, the relative tightness of the labour market. And so basically the story was about how these very sensible central banks are starting to look beyond the official data to private surveys, which are more real time, such as these ones I've got in front of you here, which are from places like Seek, like job advertisement platforms, and for instance, that have sufficient market share that they are representative of the labour market and give you a real time reading on, how loose or tight it is. Now, I have no evidence that the RBA is doing this. It is a very conservative central bank that typically, when it uses this kind of private data, it will use its liaisons material, which itself is not a very good idea, because you're liaising with business who clearly are a vested interest and are going to exaggerate things.
And it's anecdotal as well.
And it's anecdotal. Yeah, it's not representative. It's not statistically representative.
Yeah.
But I find it very hard to believe that if this discussion has reached such intensity that it's now a regular feature in the Financial Times and similar serious media, that the RBA isn't starting to question the Australian Bureau of Statistics in unemployment data. Like they must be looking beyond it to some extent, because the discrepancy between the two is getting ridiculous, basically. So we see also, we've got lots of kind of real-time private measures of wages growth as well, from NAB surveys, Seek, and other areas, and they're all showing the same things as well, which is that wage growth has well and truly peaked, and as I said, without the forced wage growth of Fair Work that intervened in Q3 last year, we would have wage growth already headed down to 2.5%. Now, they've muscled it up so that it's somewhere with a 3 in front of it at the moment, if you're looking at a kind of quarter-on-quarter basis. On a year-on-year basis, it's still at 4, but there's a whole lot of high quarters that are about to drop out, and they're going to follow the monthly and quarterly data down. And so, what is that telling you? It's telling you that you have an excess of labour, and employers have realised that big wage rises are off the table, and advertised wage growth is basically collapsing on all private surveys. So basically, you have a big gap between lagging ABS data, which is supposedly the benchmark, but is very troubled by these unusual circumstances, and you have this red hot real-time data telling you that your labour market is as loose as a goose, quite frankly. So when the RBA pipes up and starts telling us we need productivity growth, or we're not going to get wages growth, or wages growth will be inflationary and things like that, they're talking in orthodox terms that in this circumstance make absolutely no sense whatsoever. It doesn't matter that Australia has no productivity growth at the moment, because what it does have is a permanent labour supply shock going on, with just masses of cheap foreign labour flowing into the country. So when we consider, how much will the RBA take this into account, I simply don't know. I can't say it can't possibly be ignoring it. Like, to ignore all of this stuff, which is happening globally, is being discussed by very serious economists around the world, would be negligent. And so it must be incorporating some of this into its thinking, even though in public terms it hasn't mentioned any of it.
And before you keep going, Dave, I'm just going to jump to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So back to you, Dave. I guess in terms of what we're looking at from the central bank, then when is the next sort of when do you, if they are going to start talking about it, or what are the signs? I guess what are the signs that they're starting to follow this? And in terms of your view, what are you watching to, I guess speeches and
speeches. I mean, it's a new RBA with a new regime, and its new composition was explicitly about bringing in external voices, so that it wasn't suffering from the groupthink that it did for the last decade, which meant it held rates too high for 10 years, and we were, stuck in a low inflation environment. That was the whole point of RBA reform. So I do know personally a couple of people that have been around the traps, telling the RBA that they need to be looking at this broader suite of data, and so look, it has to be filtering through. If we get signals, it will be in the speeches. I wouldn't be surprised if they do start talking about employment data. But you have to remember as well, Australian institutions are maybe once upon a time, they were open and honest to the government, but these days they're very captured by the government of the day, and so they don't like criticising one another. So if we do get signals that the RBA is starting to distrust the ABS data, then it will be very subtle.
Yeah, and I mean, the RBA has not said a lot about the contradiction between, I guess there seems to be a lot. There seems to be, the government seems to talk a lot about the housing crisis and don't seem to connect the dots. If you bring in a record number of people, then maybe everyone won't have enough places to live. It's all about developers and delays and all that type of stuff.
Yeah.
I guess, are you seeing any signs of movement on that?
Yes, there actually is some signs of movement that the government recognises it.
Yes, but it's not the RBA sort of pushing.
But it's not the RBA, no, and there's almost no discussion about the demand side pressures coming from population growth in anything. Like there is an absolute woke fatwa on the discussion of the negative implications of immigration. I mean, it's intellectually fraudulent and really pretty stupid, based on silly woke ideology. But that's the way it is, and so all the discussion is about how to address it via the supply side rather than by easing demand. But
and can I just characterise that as well for anyone who's so it's not what saying. David's not saying he's against woke as is against sort of having equal rights for everyone and respecting people and all that type of stuff. What David's saying is what's happening is if anyone says anything about should we have 50 million people coming into Australia every year, or should we have 50,000? And people go, well, 50 million is too much and 50,000 is too little. Is that theoretically there's an argument about what is the right number for the capacity and all that type of stuff. Whereas what's happening at the moment is as soon as you talk about it, let me talk first. As soon as you talk about it, it's like no. If you're at all negative, you must be racist, and it must be
Well, that's right. But I'm a macroeconomist. Like I'm not interested in in race, gender, or anything else. Like, it's irrelevant to me. I'm just looking at the numbers and the story they tell.
Yeah.
But sadly, that top-down view gets blocked from the bottom-up view that any discussion in reference to immigration is racist. And okay, like, I know these people are trying to do good, but if your immigration is creating distributional pressures in your economy that are negative for the vast majority of people, well, then you really do need to kind of thrash it out. So
yes.
So anyway, that's where I'm at. So if we flick off, and this is where you asked me, are there any signs that this message is getting through? Well, yes, there are. I'm not from the RBA, but the RBA will follow the government anyway. But there is a bit of panic in the government because it's basically the government's fault, right? They overcooked immigration. In particular, a year or two ago, 18 months ago, Albo went to India and signed a bunch of like labour exchange agreements, which were just unbelievably bad in terms of equalising Australian qualifications with Indian, even though they're preposterously, there's a preposterous quality spread between the two, and a number of different agreements. But basically, what he did was tear down the labour market wall to India. And so we've had massive flows of delightful Indian people into Australia, and that's comprised the majority of the surge. Now, the problem is, those deals were not, they're not very old. They were part of a geopolitical pivot for the government, as well as making friends with India as a part of, kind of getting away from China, and part of the Quad, which is supposed to be, kind of containing China, and the US is we're friends with India. India is the new emerging market that, everybody's kind of relying on to take the mantle from China as it declines. And so they're all well-intentioned, but they've just overcooked it. So we've had this immense surge of people, and they are now, I haven't put any of this in, but they are now cutting. This is the bit that sort of suggests that they are aware of what they've done, is that they are cutting hard into approvals for student visas now. Now, they haven't changed any of their top line population growth targets and things, but student visas, I believe, have been halved in recent weeks. Student visa approvals, and that's the top of the pipe right there.
Yeah, and am I right in saying, so you're looking at these quite high numbers. While you're saying it's the government's fault, it's not the government's fault in as much as they targeted to bring this many people in, is it? I think their target was sort of like 400,000 or 300 or 400,000. It's just that they mistook all these things that they've done to open things up.
Well, they overdid it.
Yeah, they mistook. They didn't know how big the effect would be, which was a bad, poor judgment rather than they're not sitting there going, how many people are going to let in this month and how many were not. They're just changing the policies, and then people come that come.
Yes, and these are macro level policies. So they're always blunt tools, but they did. Like, when they did all those agreements with India, Leith and I looked at each other and said, "Oh dear," like that. They're really going to be in for it, because They did a couple of other things. More work hours were allowed for students and things like that, and it was just like a red rag to a bull. It was like, you're going to get a flood of people here now. It was obvious at the time, but for whatever reason, their judgment wasn't sound enough, and so they overcooked it. But now they're trying to unwind it. It's just that I think that some of these Indian deals are quite, what would be the word for them? They're just, they're very, very open. And so closing them is not going to be terribly easy. It's going to be difficult. So I'm not sure how fast they're going to succeed in slowing immigration. it may continue faster than they want.
That's where I was leading to with this, was that you've got, and actually I just want to highlight as well, there's a few questions out there from HC Lee and Harold Gray. We will get to those ones.
Yes.
So yeah, and drop in any questions if you want into the chat. We'll get there. But yeah, it's this idea that what they were targeting was 300 or 400. They got it completely wrong, and it went to sort of double that. Now, in terms of making a mistake, in terms of their tightening, I guess it seems as if I guess what you're saying is that the risk at the moment is they're going to do too little. It's not that they're going to overcorrect on the way downwards. They're actually more likely to do too little and sort of go, yeah, we want to bring it down to 250 or whatever 250, 300, I think, is that their target?
And then, look, I can't remember their target for for this financial year, I think, is to get it to 350, I think, and then 250 the year after.
Yeah, but the risk is it's 450 or 500, and then it's only 300 or 350 or whatever.
Yeah. The risks are to the upside that they keep missing, but their problem is by doing so they'll continue to push inflation into those contact points in the economy with the migrants and
keep wage growth down.
And wage growth will keep falling. And so for a government that's looking at an election, you're talking, they've created the perfect environment for falling living standards, right? Which are very easy to argue against for an opposition. It's really easy to sit, really easy. Like the government can simply stand up and say, we'll spend less and we'll cut immigration and your interest rate will go down. That's it.
Yeah. And it doesn't matter what I think about a whole bunch of other things, whether I like the people or don't like the people. In the end,
it doesn't matter
if you can see the evidence is in terms
of
the economic outcomes.
Because existing Australians, including of course migrants, which makes up 30% of us, their living standards are getting absolutely belted. On this, because the wage growth is tumbling and the inflation is coming down slowly, and it's killing us. So I didn't put this chart in, but if you compare Australia to the rest of the OECD, our living standards are absolutely plunging, whereas everywhere else, real wage growth is now trending up.
Yeah, well, and I've seen the chart as well that sort of goes when you do the nominal GDP growth, or it might have been income, income growth for people, for Australians is actually right up there. Yeah, disposable income. Yeah, Australia's right up near the top of OECD, and then you do it per capita, and we're like right at the bottom.
Yeah, that's right. Like we're going back at like 6% a year. I mean, we're talking, a 3-year government will have wiped out
15-20% of your income.
I mean, it's catastrophic for a government. It's catastrophic for Australians. And for the government that engineered it, it's calamitous. I mean, if you have sadly, we don't have a competent opposition who are busy, with really silly distractions like nuclear power. But if they wake up and just make this very simple living standard story their platform and ignore everything else, then Australians will flock them. There's nowhere else to go. So anyway, that's by the by. So they realise they've overcooked it, so they're trying to cut it down. I think they'll struggle to do it. Some of the other things that they have done to help the RBA, they have put through some tax cuts, but you can see they're actually tiny. If you look on the right-hand chart, the other thing that's been killing Australian households is the tax take has been absolutely going through the roof because the Labor Party removed allowed through COVID and things, and so that's another thing killing households is their tax bill's gone through the roof.
But there's also the concessions were the lower income people anyway who are suffering the most from this in the first place. So
sorry, I've lost you there.
Sorry, I was just saying the issue you had as well was that the tax
concessions.
Sorry,
mate, I lost you for a second.
Yeah, I was saying the issue you had was that the tax concessions they removed were the ones affecting the lowest income people anyway, who were the most affected in terms of demand side. So, but and the other one, so a lot of that growth in taxes, so it's a mixture of those, but probably the biggest chunk of it's probably just inflation as well, just driving people, as we've seen more. Finally seen some wage growth,
and there's been a little more wage growth, and so some of it's bracket creep as well, and of course it's population growth. It's more taxpayers, right?
Yes.
So, it's all those things. So, but basically, it's for most people again weighing against their disposable income. So that's not helping the story. But one area where they have, sadly, they buggered up energy as well when they first got into power and gave us an energy shock out of the Ukraine war. They've woken up to that now, and they've put a wedge between the gouging of the energy cartels and households via rebates to households, fiscal rebates to households. So they have fixed that component of the CPI with giveaways to households. Or
giveaways to the cartel, depending upon how you want to frame that question.
Well, I mean, that's like, it depends how you go about it. If you don't get any greater taxes out of the people doing the gouging, then all you're really doing is shifting the burden from the CPI into the tax system, and it's all a scam. But like Queensland, for instance, today put in a new suite of electricity rebates linked directly to their recent hike of coal royalties. Now, that's great policy. That's terrific policy. Bizarrely, there's a bunch of economists telling them that they're doing the wrong thing, but they're not. That's perfect policy. Like tax the resource companies more and hand the money to the households, and bada bing, bada boom. It comes straight out of CPI through lower bills, and yes, maybe they'll spend a little more, so you may get a little more inflation at the margin from more retail spending, but it's so screwed. Yeah. It'll be tiny compared to the effect on the CPI of the energy rebates. So they are doing some good stuff on that front as well. So that's kind of going to help. So where does this leave us? What will the RBA do? Sort of embarrassingly, I suppose, but then, being a central banker is just a case of permanent embarrassment. At the last meeting, they just removed their tightening bias. And so they obviously were signalling to the community that monetary conditions were tight enough, that disinflation was falling at an appropriate speed, and they're on track with their forecast, as they still are, as we saw in the opening of this presentation. And they were right to remove that tightening bias. So one thing they could do at the next meeting, if they feel that spooked by 1/4 of inflation, is they may reinstate that bias without actually the intention of ever acting on it, just as a jawboning exercise. So that just to spook the community a little more, keep them from spending, make sure they stay on their track. This is one thing they could possibly do. I wouldn't do it. I don't start doing it because it looks like panic, even doing that to me after 1/4, when you've just removed it, putting it back, and then you're going to remove it again the next quarter and then put it back. I mean, like, these forces are big and long and structural, and they take time, and we know all of that, especially monetary policy effects. So I actually think they'll do nothing. I think they'll just absorb this as a bump in the road, right? Yep. I don't think that they will move back to a tightening bias. They may, in some of their rhetoric, mention some of the, in fact, they're certain to say services inflation is proving sticky and will take time to come down and blah, 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 but that's in our forecast and whatever. And so there'll be some hawkish rhetoric, but I doubt that they'll do anything in terms of, forget hike. I don't think they'll hike. I think that would be madness. And the chart we've got here tells us why. I'll get to that in a second. But I don't think they'll even jawbone. I think they'll just absorb it. But what this chart tells you, this is cost of living indexes. So this is a sort of real measure of what costs households are facing at any given moment, and so it includes things like interest rates and mortgage rates and things that are not included in the CPI. So it's a much better, closer measure to real cost of living. And as you can see, the current spike is unseen in 35 years, and you'll see that there's a much bigger spike at the top, and that's the one that matters most. That's the employee households one. That's like everybody.
So let me just define for people the so that's that one. All the other ones are generally age pensioners, retirees, that government transfer, so people on the dole and things like that. So that's So what it's saying is, if you're a retiree, the inflation rate you're facing is maybe half the maybe not quite half, but it's close to half the inflation rate faced by people who have a mortgage, and are out working.
Yeah, and I mean, if you're a pensioner, you're CPI linked, so well, you're not creaming it, but your living standards aren't falling. So.
And your interest rate, if you've got money in the bank or whatever, has probably gone from zero to something.
That's right. Yeah. You're very unlikely to have a mortgage. So what this chart shows you is immense pressure on households, which is 60-70% of the economy. Now, if you want to hike into that chart, you're a maniac, in my view. You are going to destroy Australian households and put them under for a very long period of time. Like, it's just too much. Like, you have by far the largest component of the economy, 2/3 to 3/4 of it is in recession. It's been in per capita recession since the day Albanese was elected. You're looking at least 10% fall in living standards over that period. And so households are absolutely at the edge of an abyss here. And the RBA knows this. The RBA knows that this suffering is going on. And so there's a lot of disinflationary pressure in the household sector. Now, it's being offset by lots of immigration and lots of the building going on around immigration, infrastructure in particular, with state governments having to build whole new cities and roads and bridges and God knows what. But I put it to you that chart is politically unsustainable at best. And for the RBA, I think that's just enough. We're tight enough. Disinflation is going to continue. We're on their track, and so I just don't think they'll panic. So I think basically what I'm saying is ignore the last quarter of inflation numbers.
Now, I might come back to H.C. Lee's question, Dave. So can you say more about how the RBA sets up their version of a neutral rate for the Australian dollar? So based on the Australian economy is different from the US, and so the components of the neutral rate are different.
No such thing. I don't have a neutral rate. There's the long-term average, which I think has been falling for a number of years. I think the long-term average, it used to be sort of considered around 75. I think it's closer to 70 cents now. But they view the dollar simply as an adjustment mechanism. So if the economy is really struggling, and let's say, which is what I still think will transpire, that the current China property bust will end up killing iron ore stone dead, and we have a huge income shock in Australia over a period of years, and then the RBA would be quite happy for the Australian dollar to fall to 30 cents. It wouldn't mind. It wouldn't care. Now,
it would care a little bit.
It might weigh against it a little.
Yeah, but it's not.
But it's not going to really care. And I'm not making this up. Governor Former Deputy Governor Guy DeBell was asked this particular question a few years ago, like, do you have a number in mind for the Australian dollar, and what would you do if it's really started to fall? And he'd say, well, it would fall in circumstances that are appropriate. And the journo said, well, at 50 cents, would you intervene? And he said, no. And at 40 cents, would you intervene? He said, no. Right. And at 30 cents, would you intervene? And he said, no.
Okay, there you go.
So that was from the horse's mouth. I mean, so like, the dollar is. Yeah,
I know what you're saying. I think though as well, it's the part of where it's they're not going to be actively out there against it, but it's going to factor into their thinking about what they're doing with interest rates.
It will, and conversely, like when we had the mining boom and it went to $1.11. They cheered it on because they were happy for what it was doing to squash inflation,
and decimate our manufacturing sector.
Well, that's not in their not in their frame of reference. But
I think as well. I mean, my take on that one is that they're actually pretty good at calling that whole mining, the whole rise of China, like quite early, and then but they congratulated themselves so much for their call about the rise of China that they then thought it was going to go for the next 30 years, and so we won't need a manufacturing sector.
They did, exactly right. Okay. And in fact, the car industry was thrown into the sea literally like days before Xi Jinping announced that they wouldn't be building any more apartments, and the entire mining boom cratered for the next 5 years.
Yeah,
like it wasn't the next day, but it was within months. And suddenly the Australian dollar went from $1.11 down to God knows what. I can't even remember how low it got. But it went from a car industry that couldn't export a car to a car industry that would have been absolutely pumping cars all over the world like 6 months later.
Hey, quick message. Quick message, and then we'll jump back with investment implications.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so back to Dave. I think I realised some of those other questions I thought were more statements. You can read them yourself in the chat. But if anyone else has got questions come up, pop them in the chat, and we might go to the investment implications from Dave.
Sure. So, I mean, I think basically the RBA cuts, which I was, after the December quarter, got all excited and said they might even go before mid-year. Leaf has always been saying sometime in the second half. The CBA team had September penciled in, which was, I think, was a pretty reasonable bet, and they pushed it out to November, I think. Now, so just a bit tighter for a bit longer. There's one other factor in this, and that is that mortgage rates are still rising, by the way. We've still got the fixed rate roll-off happening, and so mortgage rates across, in an aggregate sense, the RBA is still tightening. It's still getting tighter. So.
Well, this is this interesting one. I look at it in terms of what is the mortgage rate, and I feel like for houses, it's like, okay, what is the mortgage rate for somebody who rocks up to a bank and says, yeah, I want to borrow some money to buy this house, and that's been sort of flat for a long time. Like that's stopped because it's the 3-year fixed rate is below the variable rate. Even though the variable rate was still rising, it's like, well, if somebody turns up and says, do you want a 7% variable rate mortgage or do you want a 6.5% fixed for 3 years? People are going, well, I'll take 6.5 for 3 years. So that stopped rising years ago. But you're right, the average amount paid by people is still going up.
Yes, it is still going up. So they're still tightening. So there's just no need to tighten anymore. But I think that like the parlous, like all of the consumer data I look at just shows whether it's confidence spending, credit card data, it all cratered again in March after everybody, kind of, picked up their spirits over Christmas. Going into April, the data still looks terrible. And so Australian households are just under enough pressure. There's enough disinflation in the economy coming out of its largest segment. You don't need more. So I think but you are going to need cuts at some point. And so November sounds all right to me. At this point, you're just shooting in the breeze. I still think it's odds on that we get a cut sometime this year. And then, once they start cutting, I think they keep cutting. Like the critical input will be how low immigration goes. If it does get cut to 200,000, then, we might end up ultimately with a cash rate that's cut, to 2%. If it stays at 300,000, you can add probably 50 basis points. If it stays at 350, it comes down to 3.5. Like it's just this is.
If you want to run at 700, then we're there.
This is the perversity of today's discussion. Economic discussion is the number one input into interest rates. Nobody can mention. Like it's just weird. It's just weird. It's Twilight Zone stuff. Anyway, we'll move on. So investment implications. Like we've been looking for a pretty good bond rally and had had a couple of goes at it. Where the 10-year in the US has kind of sort of gone from 5% down to 3.8 and now blown back out to 4.6. And in Australia, we're kind of ebbing and flowing around that US 10-year, where we get to positive and negative spreads depending on our own conditions. Obviously, this delays the bond rally somewhat until it's tight enough and everything's loose enough. Australian dollars are a funny one at the moment. It's really stuck in the mid 60s. It's had a little bit of a bounce out of the recent CPI stuff, but I think the market realized pretty quickly that it hadn't really knocked the RBA off course, and so it's retrenched much of what it gained. And on one hand, you have China dying, which is incredibly negative for the Australian dollar. And on the other hand, you have the US economy going into this kind of super boom of AI and God knows what else. Not bumpy free, mind you. They've also got relatively tight monetary policy, addressing their labour market shortage. But you have a lot of very large forces kind of up and down on the Australian dollar at the moment. So I've just kind of embraced a bit of a mid-60s range there for the time being. And there's this huge kind of structural short of speculators on the AUD, which I think is a sort of proxy against China, which means it can't really fall that much because everybody's already short. But there are big forces coming down on it, and I think the US dollar is likely to rally in the months ahead because the Fed, the long end rates in the US, need to do the Fed's work for it and get it back on track for its disinflation. So the AUD is stuck there somewhere, and likewise stocks are just absolutely beholden to the same set of variables at the moment. We keep going through these mini boom bust cycles where the market is incredibly febrile. It goes 1 minute it's all immaculate disinflation and AI and got to buy everything in sight, and the next minute it's one bad inflation report and the Fed's got to hike again. Oil's played a role through geopolitics, although that appears to be largely over. I'm not saying the wars are over. I'm saying the impact on oil seems to be easing. And you got this structural US labour shortage, which is the real challenge for the Fed, and is keeping wages high. But they don't want to kill wages either. They just need them a bit lower. Like, as we try to say, a 4% wage, if you've got 2.5% inflation, is a pretty kick-ass environment. So we're going through these crazy rallies and sell-offs based around, whether the disinflation is immaculate or not, and then and then suddenly it's a no landing or a soft landing. I mean, I personally still think the US is in a soft landing. If you look at wages, earnings there, they've come right off. They've been falling for how many quarters, Damo?
A year and a half.
Year and a half, earnings have been falling. I mean, that's a landing. Like that's not no landing when you've got no earnings growth.
But what's been interesting is that we've really seen some big downgrades in terms of the near term numbers, but the longer term numbers just sort of drift down. So what you see is that coming into, say, the first quarter, I think you go back 3 or 4 months and people were sort of forecasting it to come in at 3 or 4%, and now it's coming in at minus 3 or 4%. And so you've had, whatever it is, a 6% swing, but stocks really haven't been affected that much. And if you look outside the sort of big seven, or the big six even, that of like your Microsofts and Amazons and Google and Facebook, is that it's down way further than that. So those stocks are pumping. They've added, say, 3 or 4% to the market. So you've gone from saying, but the later term forecasts are just sort of gradually drifting down. They're just or staying high. And so I think every quarter for the last 3 or 4 quarters is like, well, this quarter was really bad, but things will improve. And
yes. Well, it's the old stockbrokers game, isn't it, that one? So
but I think as well that there is a certain part usually where markets go, there's an expectation of what earnings growth is going to be, and then it gets to a certain point and they then go, right, that's it, we were wrong, and you get a readjustment, and then markets sort of correct lower. And we were expecting that to happen sort of near the start of this year when we saw earnings, the earnings growth rate sort of halved or more. But the market just roared straight through it. And so, I think that the bulk of those earnings, the bulk of the sort of unrealistic earnings, we've already seen the downgrades for. There's still more to come, but we already got through the bulk of them, and markets didn't really seem to care that much about it. So it's sort of question about, well, will there be a straw that breaks the camel's back, or will we just drip away and markets will just sort of oscillate around current levels, up a bit, down a bit, up a bit, down a bit, until earnings start to recover in 12 months time.
Yeah, I mean, you get out a year or two, and I think you're starting to see AI impacts as well.
Absolutely.
And
can the market bridge that gap? I think they can now.
Well, that's exactly it, right? That structural labour gap in the US is going to disappear thanks to AI, and probably have a surplus, sadly. And the weight loss drugs as well will boost labour participation and things. So all of those things the market's so excited about at the moment, they're all very deflationary. So you go out a couple of years, and I still think that you're going to end up with relatively low neutral rates. But we are going through this crazed market which just overreacts up and down on soft landing to no landing to hard landing and back again. And each sort of iteration has maybe 3 or 4 months in it, as we sort of wildly oscillate around the trends, the macro trends. So I guess I would say I would expect that kind of volatility to continue. But ultimately, I mean, unless we get a full bore no landing from here, there are, global industrial production is picking up a bit and things. It's looking a bit better in Europe. China's sort of spending enough to not fall apart. Japan looks a little better. There's something of a recovery underway, but it still only looks like 3% GDP growth globally, which is not strong. That's a softish landing. Then, I think we keep sort of slowly drifting down and through this disinflation, and this last mile might take a couple of years before we get into those really heavy-duty deflationary impacts of the new tech that's coming.
Yep. Right. On that note, I think we might wrap it up. Thanks everyone for listening. Like and subscribe. And if you want to hear any more from us, you can jump onto the web, nucleuswealth.com. Sign up for any of the podcasts and blog posts that we write, and also see more about what we do there. And we're on every Thursday, 12:30, or most Thursdays. The last 2 weeks are excluded, so apologies for that. So we'll see everyone next week for more from us. Thanks, and we'll catch you next time. Thanks, Dave.
Okay, thank you, everybody.